Today, we will talk about how invested capital is crucial for companies and how they calculate returns on their investments. Let's learn about the definition and how-to of ROIC. Invested capital is the total amount of money raised by a company through securities issued to equity shareholders and debt to bondholders. This includes the total debt and capital lease obligations, added to the amount of equity issued to investors. While invested capital is not listed as a line item in the company's financial statement, it's crucial to understand that debt, capital leases, and stockholders' equity are each listed separately on the balance sheet. Companies need to generate more in earnings than the cost to raise the capital provided by bondholders, shareholders, and other financing sources. These metrics include return on invested capital, economic value added, and return on capital employed. A firm's total capitalization is the sum of debt, including capital leases, plus equity sold to investors. These types of capital are reported in different sections of the balance sheet. A successful company maximizes the rate of return it earns on the capital it raises. For example, when a company issues new shares of stock and uses the proceeds to invest in new assets, its earnings and dividends could increase. Companies may also use a portion of earnings to buy back previously issued stock, reducing the number of outstanding shares and increasing the earnings per share, making the stock more attractive to investors. Return on invested capital is a calculation used to assess a company's efficiency at allocating the capital under its control to profitable investments. It gives a sense of how well a company is using its money to generate returns and reveals if invested capital is being used effectively. ROIC is calculated as a percentage and should be compared to a company's cost of capital to determine whether the company is creating value. Here are 3 key takeaways. 1. Invested capital refers to the combined value of equity and debt capital raised by a firm, inclusive of capital leases. 2. Return on invested capital, ROIC, measures how well a firm uses its capital to generate profits. 3. A company's weighted average cost of capital calculates how much invested capital costs the firm to maintain. Hope this would help. Thanks for watching.